Boom. Hey everybody, what's going on? My name is Arman Vakili and this is Stock Splits, the show where we talk about stocks that split. And super creative, I know. But the definition of stock splits, just in case you guys didn't know, is when a company divides the existing shares that they have into multiple new shares so that they can boost the liquidity and also actually increase the company's market cap and overall value, right? Although number of shares are going to be increased by an actual multiple, and then I'll explain what that means, the total value of the shares is going to stay the same compared to the split amounts because the split doesn't actually add any value to it. So what that means is if you have $1,000 worth of shares, even though the price of the share is going to change and then it's going to go from whatever to whatever, which I'll explain right now, your actual value of the shares is going to stay the same. So let's press it. Here we go. The most common split ratios are 2-to-1 or 3-to-1, and then expressed at 2:1 or 3-to-1, which means that the stockholder will have 2 to 3 shares after the split takes place, respectively. So what that means is this, okay? So before the split, it's 2,000 shares and it's at $100 a share. After the split, oh, you know what? That's supposed to be that's supposed to be backwards. I have some kind of dyslexia, so don't be mad at me. But the dollar amounts are supposed to be backwards right here. So the before after is the same. So the 2,000 shares is going to go to 3,000 shares, but your actual dollar amount, if it was $300 a share, it would become $100 a share. But then $100 a share at 6,000 shares would be 6,000, where $300 a share at 2,000 shares would also be 6,000. So that part is supposed to be, I'll change it for the next episode, but that part is supposed to be split like that. But that's exactly what it looks like. So if it's at 2,000 shares, technically when it splits, those 2,000 shares are going to split into, if it's a 3-to-1, it would split into 3 new shares. So each share would split into 3 new shares, which ends up being 6,000 shares. But that also is because the price of the share has dropped. So your overall portfolio value stays the same, but the prices have changed. So our first case study is going to be Apple Incorporated. And we're going to talk about the number of times that they had a split, and then what happened to the actual stock prices, the market cap, people's portfolios, etc. So here we go. The first, they split 5 times, excuse me. So they split 5 times, right? First one was in 87, which was a 2-to-1. Second one was in 2000, which was another 2-to-1. And then there was 2005. And then 2014 was the first like really big one, which was 7-to-1. And then the most recent one was 2020, which was 4-to-1. And so these were the different times, and you can see obviously the first 3 were just simple 2-to-1, 2-to-1. It wasn't really this crazy thing, and then we'll actually see what the stock price looked like at these different time points. It's really interesting. But 2014 was the really like first major one, and you can kind of tell because they really needed to lower the price of the stock, and it allows people, it gives accessibility to people, right? So, and then 2020 was also a 4-to-1. So let's see what that looks like for these people right here, these Apple, beautiful company. I don't know why I even inserted them. You guys know what that is, but just in case you didn't know, I guess for other companies, if you don't know who they are, we'll also look at their website and their brand and stuff. So this is their stock split history, and here we go. So first one was what? The first one was 87, 2000, 2005. That's the first like basic 3 ones. So if we go to 87 right here, and let me zoom in on the screen so you guys can actually see this. So if we go to 87, the price was what? It was like 46 cents, okay? And then the next one was, I forgot already, 2000 and then 2005. And then if we go to 2000, which is like right here, is $1.14, okay? So nothing crazy, 46 cents to $1.14. And then 2005, we go right here, $1.46, okay? Pretty interesting. Now, one thing I want you to pay attention to first is the line right here. This line, it doesn't really look like anything is going on with this line. It looks like it's pretty much a flat line. And then 2005 happened, right? So 2004, 2005, and then you start seeing these little spikes go up. And you start seeing the price of this stock constantly increase. So right here, you're at $1.46, okay? By 2006, you're almost double. So you're due 257. And then you go a little bit further, and right here, End of 2006, you've doubled up already. And then you're going up, and now it's doubling even faster, right? It's getting pretty close to, whoop, we just crossed right here. So 2007. So it quadrupled in a matter of 2 years, okay? It went from, like about 130, 140 right here. This is where it kind of starts, and that's in 2005, like mid to late 2005. And in 2007, same time, we're over. We're almost quadrupled at this point. Almost, I said. I know that the math wizards and the technical people are gonna kind of try to crucify me for that. But then there was like a little bit of a drop right here. So this was the third one was when 2005 was 2-1, right? And so you start noticing the price increase right after 2005. And so 2014 is when they had a 7-1. So if we go right here and we go to 2014, they're at $25. So you gotta put this in perspective, okay? And I'm gonna put my phone out so I can do like the proper calculation here. If you have $1,000 in 2005 and it was at $1.40, whatever it was. Let's say I'm gonna go from July, around the July area. So like let's say end of July, so $1.50. So if you had $1,000 in there and it's at $1.50, okay? Our $1,000 is going to, we're gonna come right here in 2000 and it was 14. Yeah, 2014. So in 2014, end of July, okay, I can be like right there, I guess like beginning of August. So 23.69. So 23.69 divided by $1.50, whatever it was, it's 15 times. So if you had $1,000 and it's 15.79, $1,000 times 15.79 is $15,700, $790. If you had $1 million that was invested, that would be what? 15 million. Okay? So now, watch this. This was the first, and then like pay attention to this graph right here, okay? So this was the first time that they do this like major stock split where it goes to a 7-1. So you still have your portfolio value. But what happens is that they drop the price again so that newer people, and this, because you got to understand, this was at a time, especially like prior to when these apps that make it easy for you to buy these stocks or like buy portions of stocks and all these different things. A lot of time you needed access to a brokerage account, or you needed to get you need to get your foot in the door with some kind of financial institution to even be able to purchase stocks. And then to be able to get portions of stocks was almost unheard of, right? Like, and you needed special access to be able to buy a portion of a stock instead of the entire, like actual, I can buy one stock in this company. So for some people, and this $24 is still not a lot of like money for one stock. But let's say if you only have $100 and you're looking at penny stocks versus something that's $24, whatever, and then they drop the price. So, okay, this is what's interesting. They drop the price, and then now you can actually buy the stock easier or more of it if you're starting smaller. So it opens the gap up. It opens the room up for a lot of other investors that are new investors. They're rookie investors. They're just kind of dabbling. It opens the room for these people at that time that you didn't have access to these apps for you to be able to purchase these stocks in these companies. 2014, there's a 7-1 split. And then so we have a spike in the performance of the stock right here. 2015, you have this drop, but this was one of the drops that happened and it took a lot of companies. So it hit a lot of companies in 2015. It's not really that big of a deal. But then you have this crazy growth again. And in 2018, another little drop, but within a matter of there isn't a situation where it takes longer than 12 months for the stock price to recover. And then obviously 2020, the pandemic and that crash that happened at the beginning, it hit everybody. But the stock price and the value of the company, so 2020 was also another stock split, right? It was April of 2020. I remember that one because I bought into Apple a decent chunk of money because I knew that there was going to be a spike that was going to happen. And typically, usually, any kind of like major correction or any kind of major crash that happens like this, there is going to be an immediate recovery within the market within 12 to 24 months. It almost always happens when within 12 to 24 months after, and I think actually I can probably say always, that within 12 to 24 months after a correction or some kind of a crash within any kind of a market, there's a recovery. And if you buy low, so if you know that there's going to be a significant dip like this, and even if you don't know if there's going to be a dip like this, but you just pay attention and you say, you know what, based on the average rise and falls of the market, when something over 10% or 15% or 20% drops in the market like that, that typically means that that's a really good time to buy. If you have that major drop, or if there's a stock split that takes place, right? So it's one of those two things. And stock splits, thankfully, are announced. You can actually look up the scheduled stock splits for all these different companies. So this is what happens to the actual value of the stock. Okay, now check out what happens to the market cap of this company. So 2005, right, was the first like section where kind of the growth started, and that's when we started seeing these returns or the growth that when it went from like that 150 and it started doubling and tripling real quick, right? So 2005, 2006 is when market cap kind of right here, boom. So 2005 is around the time that we had, and a market cap steadily rising. And in 2014, right? Where are we at? 2014, 2020. I should probably just remember those. But 2014, so 2005 was that split, and then by 2014, the market went up to $600 billion. It went from 40 or 28. It went from 28 to $600 billion. That's what happened to the market cap of this company. And I'll explain why this is important. The market cap of this company grows, and then this was the other stock split, the 7-to-1 that happened. And ever since the 2014 7-to-1, the market cap has gone on to $2.3 trillion. Okay? Why is this important? Because if you're going to be splitting, or if you're going to be looking for stock splits, if you're going to be looking for purchases of companies, and you're trying to figure out, okay, well, how do I know that these companies, this list of companies that are going to be splitting in the upcoming 12 months, how do I know that these companies are going to be solid companies for me to invest into? You look at the company's market cap, and this is something that you can do as simply as Googling it. Like literally, I Googled Apple market cap history. That's it. And you look at the company's market cap, and you see how strong the company is and how viable they are over the long term, right? If they've been able to survive 2 decades within the modern economy and everything that's happened over the last 2 decades, because the economy like transformed almost like drastically as hell. I don't exactly know what the perfect example or the perfect word, verbiage, phrasing, whatever it would be. So because of that, it gives you the strength of the company, where you can know that where you can invest into, and you can expect typically a decent return. So it's not a bad thing to look at, and you can always find a list of these companies, and we're going to be talking about all these different companies as well in the future episodes. So it's not really that bad to look at. It's something that's actually pretty interesting to learn about, and it's one of those market hacks, quote unquote, that you can implement, that if you study it and if you test the waters a little bit and then get to know these different stocks and these different companies, you'll have a decent chance of making some money. Now, granted, I'm not a licensed investment advisor, so please don't take this as official investment advice. Go speak with somebody who's a licensed advisor. Make sure that you understand that there's a possibility that you can lose your money, all that stuff. That's what stock market is. That's what stock investing is. But these are the calculated moves. These are the theories and the processes that people implement so that they can ensure that their investments actually yield significant returns. So look into it, check it out. If you have any comments or questions, leave it for us below. And I will look forward to seeing your guys' questions and comments, and look forward to seeing you in the next episode. Thank you so much. My name is Arman Vakili, and this was Stock Splits. Later.